So in lesson 1, 2, we're going to get some of the basics of accounting that are so important before we move on to anything else. And so a couple of things, first of all, as we're working through this chapter or through these first 8 chapters, we're going to be working with what they call a service business. A service business is a business that performs an activity for a fee, like a barber shop or a nail salon or a car wash or something like that, where you go and you have something done and you pay for it. Delgado Web Services is going to be this guy named Mike Delgado who goes out and does web pages for different businesses and individuals. A proprietorship is a business owned by one person. And so those are kind of what we're going to be dealing with for this first whole semester. We will talk more about the generally accepted accounting principles later on, but they are basically rules that anybody who works in accounting has to follow. So a couple of vocab words here. The first one is equity. Equity is the financial rights to an asset of a business. An example of an equity would be when you have equity built up in something. So if you own a car that's worth $10,000 and you go to the bank and you get a loan for that amount when you buy it and you pay it back and pay it back. And let's say at one point it's worth $10,000 and you owe the bank $6,000, your equity is $4,000, the difference. So if you went and sold that truck for $10,000, you'd pay the bank back their $6,000 and you'd be left with $4,000. That's your equity. In a business, what we call owner's equity is the difference of liabilities and assets, which we talked about in section 1, and I'll go over another slide here again. And then we have our ever most important accounting equation, and we'll get to that here in just a second. Here's our accounting equation: assets. Assets are things you own. So in my example a minute ago, the truck itself is the asset. It's worth $10,000. You own that truck. Liabilities are things you owe. You owe the bank $6,000. You owe that to them. And so when you take assets, what you owe the bank, what you have left is your equity. So the way we state, so owner's equity is what's left after liabilities is subtracted from assets. But we state the accounting equation as assets equals liabilities plus owner's equity. So what you owe and the equity you have in that asset added together equals our assets. And that's all. We are going to be using this accounting equation until the day you stop doing accounting, because it is the heart and soul of accounting. You have to memorize it. You have to know it. Assets equals liabilities plus owner's equity. Assets are on the left side of the equal sign. Liabilities and owner's equity are on the right side of the equal sign. So when they say left side, right side, they're talking about that equal sign. So something that changes the accounting equation is called a transaction. And we're going to work with those here in a little while as we go through this lesson. An account is like an account that summarizes all the transactions that pertain to one single item. You give it an account title. The amount in that is called the account balance. And then the capital account is going to be an account we're going to have that's going to summarize our owner's equity. So as we start working through these transactions, you'll see what those mean. So the first transaction we're going to do is receive cash. So in this transaction, we received cash from owner as an investment. Typically what happens when a person decides to open up a small proprietorship, they're going to maybe have some savings that they've built up, and they're going to take that money and they're going to invest it in the business to start the business. Basically, they're going to move it from their checking account to a new account in the business name. And so when we receive cash from owner as an investment, we've got an account called cash. So if we're receiving cash, cash is going to increase. Cash is an asset because we own it. The owner is investing that money. So this capital amount, you can think of capital as like the owner's little pot of value in the business. So if the owner took that money out of their personal savings account, put it into the business savings account, they have the rights to that. So if on the second day after Michael Delgado does this, he wakes up the next morning and goes, you know what? I think this is a really bad idea. I don't know that I can make this business work. I don't want to do this. He can take that 2,000 back out, put it back in his personal savings and be done with it because he owns that $2,000. So since capital is owner's equity, cash is an asset. If we add to assets, we also add to owner's equity, our equation is in balance. Our assets equal our liabilities plus our owner's equity because right now our liability is 0. The next transaction. This one, we paid cash for supplies. So to run a business, sometimes you got to have supplies like staples and paper clips and tape and scissors and things like that, just to kind of have your little your office set up. And so in this example, they go out, Michael Delgado goes out and goes to say Walmart or Office Depot and buys $165 worth of supplies. And he pays cash for it, writes a check for it or swipes his debit card. So that money is going to come out of his cash. So that decreases our cash. But our balance of the supplies, he's buying those supplies, he's taking them back to his business. Those are an asset. You own those. You own all that stuff until you use it up. It's owned by you. It's an asset. So that one goes up. So since one asset went down and one asset went up, our two balances added together are still going to be 2,000, are still going to equal our capital. The next transaction, we're paying cash for insurance. Let me talk about insurance for a minute, because insurance is one of those things that a lot of kids don't have a lot of experience with. But insurance is basically something that is going to be there in case an accident happens. And you have to pay that ahead of time. Most of the time, people are going to pay for insurance either a month ahead of time, 6 months ahead of time, or a year ahead of time. And so you pay it ahead of time because let's say you have a car and you buy that car on January 1, but you don't get insurance till January 31st. If you wreck it on January 15th, the insurance company is going to say, we're not covering that. You haven't paid your insurance. So you always pay it ahead. So in this example, he's going to go out and he's going to buy insurance for his company for $900. That is called prepaid insurance because it's paid ahead. We're prepaying it. So our cash goes down because he's paying cash for it, but that asset of prepaid insurance is going to go up. Prepaid insurance is an asset until you use it. So in this example, let's say his insurance is $300 a month. So he's paid for January, February, and March. At the end of January, he's still going to have $600 in that prepaid insurance. And we'll talk later on, several chapters from now, on how you take that out of there. But until you do, that asset, that insurance is an asset to your business. So now you add these three together, they still equal 2,000, and we still have 2,000 over here. So our equation, assets equals liabilities plus owner's equity, is still in balance. So sometimes you owe somebody money. A business or a person that you owe money to is called a creditor. And so sometimes in business transactions, you're going to do something and owe someone money. So in this particular example, Michael Delgado goes out and buys supplies, just like he did 2 transactions ago or 3 transactions ago. He went out like to Walmart or Supply Depot and bought some supplies and paid cash for them. This time he's going to go get those supplies, but Canon Office Supply is going to allow him to pay for them later. So they're going to allow him to open up a credit account, get what he needs, and then they're going to bill him at a later date. And so in this transaction, your supplies, because you're getting supplies, is going to go up, your asset. And what you owe this liability, we call that accounts payable because it's an account that you have to pay. It is a liability. You owe that money, that $220 you owe to Canon Office Supplies. And if something were to happen and this business were to go under, Canon Office Supplies is going to come back to Michael Delgado and say, give me my $220. And he's going to owe that to him. So that goes up. So our assets went up $220. Our liabilities went up $220. So our equation, our assets, these added together equal $2,220. And these two added together equal $220. and $2,220. The next one, paid cash on account. So in this transaction, we're going to make a payment now to Cannon Office Supplies. So up here, we went and bought those supplies. We got them. We brought them home. They're in our assets. We owe Cannon Office Supplies $220. Now we're going to make a payment to them. So we paid cash on account to Cannon Office Supplies. We take out $100 out of our cash. We also reduce what we owe Cannon Office Supplies. So since we owed them $220, we paid them $100. We now only owe them $120. And our cash also went down $120. So our equation is still in balance. So I want to go back here and talk about a couple of rules. If you look at these as we go through, we basically have 4 rules here that are going through. And we're going to talk more about these and keep repeating them. The first one is every transaction has at least 2 accounts are going to be affected. And so the second rule is that if the 2 accounts that are affected by the transaction are on the same side of the accounting equation, like they are back here, one goes up and one goes down. Third rule is that if the accounts that are affected are on opposite sides of the accounting equation, like they are here and here, they move in the same direction, meaning they either both increase or they both decrease. And that's what keeps that accounting equation in balance. As long as that in rule 4, that equation always has to stay in balance.